Hello, everybody. Luke Gromen, FFTT. Hope everybody is well. It is a bit of a wild Sunday night here in Cleveland. We've had sustained winds of over 60 miles an hour. They're reporting that on the eastern half of Lake Erie, record 26-foot waves, which I would not want to be out there for that. So we also had another Browns win, so we're 6-3 for the first time in 6 years. So good day here. I'm going to jump right in. A couple things. Let's see. First, from the always brilliant Chris Hamilton. Question is, thoughts on the Fed's using Fed funds rate percentage to encourage unlimited debt to achieve the full employment mandate, gaming CPI to avoid any stable price mandate issues, effectively resulting in an MMT/asset price palooza. In my view, it's a good way to look at it is that they're lowering Fed funds rate, they're gaming CPI or underreporting CPI, which is something governments have done forever. The interest rate derivatives that expanded so explosively from after 2000, all of this was done in the service of the bond market and in particular the Treasury market and by extension the U.S. government. And so I think in your question or in a separate tweet, Chris, you phrased it as it's removing the free market pricing of the Treasury market. And I agree with that wholeheartedly. I think that's the whole point. And when you look at it, the biggest borrower in the world over the last 20 years has been the U.S. government. As the post-1971 dollar system has evolved, asset price appreciation and U.S. government spending have become increasingly key drivers to U.S. economic growth. And so you need lower rates, you need tame CPI to keep these deficits from creating a balance of payments problem for the United States as the debt goes higher and higher. And we're now reaching a point, particularly post-COVID, where both of those factors, asset price appreciation and low rates, and U.S. government spending, have to become increasingly extreme just to keep the wheels on the cart of the U.S. economy, of the U.S.'s fiscal position, as one of your charts showed that you posted below my questions, Chris. So I hope that helps. As a side note to everybody on here, if you don't read Chris Hamilton's Economica blog, you're missing out. I've long been a fan. He always has great charts on there with some great explanations. It really looks at economic data in a truly unique manner, so check it out. Second question from AK. DOD announcement, Shelton finally on the Senate docket, and the Asian trade deal. So I like it. I like it, AK. You're trying to go for a 3-for-1 here. I like people being aggressive. So, okay, here we go in rapid fire. DOD. And what we're talking about here is the head of the Pentagon coming out today and saying in his opening brief that all wars must end. And for me, maybe it's nothing. Maybe it's some last-minute positioning for Trump, done by Trump as he leaves, presumably. Shelton. Remember, Judy Shelton advocated a gold-backed bond as a neutral reserve asset as a way to benefit the U.S. and rebalance trade. If you had a gold-backed bond, the price of gold would have to be marked probably orders of magnitude higher to serve in that role, so we wouldn't run out of gold. So is this some sign of a late-term currency system change by Trump in trying to put her on the docket, or is this just a sort of petty political way of making things more difficult for the Biden administration over the next several years? And again, let's see. I don't know for sure. Finally, the Asian trade deal, the regionalization aspect of there is what caught my eye, particularly in the context of the central bank digital currency points made by Louis Gabb in his really excellent interview on Real Vision a couple of weeks ago. When you pair the regional trade deal of China, South Korea, and Japan with a central bank digital currency that allows these countries to transact with each other outside of the dollar and SWIFT system sooner rather than later, to me, that starts to get really interesting. That's not where it is yet, but you can line these ducks up in a row and see where it's probably going, and that to me is something we're going to have to watch. Third question from BJ. If the major central banks all build their balance sheets to infinity at the same time, hypothetically, what is the likely endgame? Isn't it possible that the dollar remains king dollar as long as the above is true? Yes, possible U.S. dollar would stay king dollar in that scenario. In that scenario, gold and Bitcoin would probably do really well as gold would likely gain share of global FX reserves, because in that scenario, if every sovereign is growing their balance sheet to infinity, sovereign bonds cease becoming a store of wealth. And so you would see an increase in the pace at which gold would gain share of global FX reserves, of global wealth reserves in the private sector. And as that happens, that would mean more and more of the debt of governments would have to be bought up by their own central banks. And then you'd say, okay, the currencies that do best and worst, you'd rank them by the governments running the biggest deficits would have the worst currency, and those running the least deficits would have the best currency. And guess who wins that contest? The U.S. hands down is number one in terms of running the biggest deficits. So that would mean that over time the dollar would be the dirtiest dirty shirt, not the cleanest dirty shirt. So in the near term, if they all debase at roughly the same pace, I think gold and Bitcoin are win, and that's why, as Kirill Sokolov says, that's what makes gold so easy. Let's see, from Kim Gitz, any thoughts on funding stress redeveloping in agency bond markets? I had not really seen that anywhere else, Kim, so thank you for flagging it. Let's see how it develops. Obviously, all else equal, rising funding stress, if you're seeing that start to develop, that tends to be positive for the dollar. Wild card within that is that the reflexivity of markets, knowing that if you see funding stress, you're likely to see stronger dollar. If you see stronger, when you see stronger dollar, you're likely, and we factually have seen bigger and faster Fed responses to haircut or to kneecap that stronger dollar very quickly. Said more plain English, when the dollar rises, each sequential time the dollar's been rising, the Fed has been stepping in with significant liquidity faster and faster. So let's watch that again. It's one of these things that's too early to make anything of, the funding stress, but definitely noteworthy. So thank you, Kim. From AS, the G20 meeting for debt relief and forgiveness for poorer countries was this past Friday the 13th. Any thoughts or insights? Yes, it was. I haven't seen anything. For me, it was one of these signposts to just see if something would come out of it, particularly in the context of the comments of a great reset that we're getting out of the World Economic Forum, out of the IMF, out of in some of the U.S. mainstream media. The informational value to me might be just that they're talking about debt forgiveness. This is not something I remember ever hearing about prior in my career. I think it's important to remember that over the past 120 years, when sovereign debt has gotten as high as it is now in advanced countries, there's only been three ways out. You either get default or restructuring, you get financial repression or inflation, or you get hyperinflation. That's it. Those are your choices. None of them are good for sovereign bonds on a real basis. So I think that's the direction we're moving, but of course path matters. So let's watch on that front. From Turner May, when are trade deficits going to start to matter again, or what will make trade deficits start mattering again? I think they're already mattering. The challenge is they're so small relative to the fiscal deficits that I think they get lost a bit in the haze, or a bit in just how big the fiscal deficit is. And so what we've seen since last year, whether it's repo rate spikes and then the Fed response, or whether it's the U.S. Treasury market going dysfunctional back in March, yields fall or yields rising as stocks crashed, and even in October when you saw yields in the Treasury market rise with the Dow down 1,000 points, these are symptoms of basically balance of payments problems in the world's reserve currency issuer. And so to me, it's less trade deficit driven and much more federal deficit driven. But I do think they're mattering in terms of what we're seeing there as described. And then the final question from RB. You talk about a bond fire. Does that entail rising bond yields? How would rising bond yields be good for gold? It seems it would cause the dollar to rise, which is bad for gold. In my opinion, a bond fire will be on a real basis. The last time U.S. federal debt was this high, real rates were negative for a majority of the next 35 years. And for the first 5 to 10 years after they were this high, in 1946, the Fed capped interest rates at 2.5% at the long end and grew their balance sheet. And I think that's the direction we're moving, and that's why I think it's ultimately good for gold. Is a bond fire, in my view, is likely to be bondholders' purchasing power getting burned, whether it's relative to equities and gold like we've seen since '08 in a very consistent manner. I think eventually it's going to be much more consistently against CPI categories as well. So with that, I'm going to sign off for tonight. I want to thank everybody for joining me. As always, if you like these updates, check us out, FFTT-LLC.com for what we're up to. And if you, like I said, if you like these updates, FFTT Tree Rings might be of interest to you. It's a Friday piece we put out, 10 most interesting things, with some topics du jour and our brief thoughts on them. So everyone have a great week. Everyone stay safe out there, and I look forward to catching up with you soon. Take care, everybody.